For those of you I don't know, my name is Joan Gable, and I'm the Dean of the Trulaske College of Business. It's my pleasure to welcome you here today to our Vaughn Executive in Residence lecture. Before we begin, I would like you to please turn off your cell phones and put them away. And I also encourage you to stay through the remarks, but also through the Q&A period, and to think about some questions you might like to ask as we are hearing from our lecturer. The Q&A will be managed by my colleague, Assistant Dean Joe Stevens, who's sitting right over there. So I encourage you to stay and participate in that process. Before we begin the introduction, I would like to acknowledge and welcome my colleague, Tom Richards, who's over here. He's the Interim Vice President for Finance and Treasurer for the University of Missouri System, and we're very pleased to have him here today, and also want to thank him because he made the introduction for our Vaughn speaker, so we're grateful if we could give him a round of applause. You have no idea how hard his job is. Plus, he's doing 2 jobs right now, so we'll talk about that later. Okay, so our mission here in the Trulaske College of Business is focused on student preparation, as you know, and we strongly believe that pairing industry experts with our students is an ideal way for you to ascertain how you want to traverse along your path towards success. We seek out business partners who have advice to share, insights to offer, different things that will help you consider your own future. Our speakers also provide frontline insights into industry trends, issues, practices, examples of how to turn challenges into opportunities, and we're really grateful when they stop their very busy lives and come here and share their wisdom with us. Today we have the pleasure of learning from Mr. Cliff Asness. Mr. Asness is the managing and founding principal at AQR Capital Management, a global provider of investment management services. He founded the company with his business partners from Goldman Sachs in 1998. AQR manages a wide range of investments, from aggressive, high volatility, market neutral hedge funds to benchmark driven traditional equity funds. The firm employs more than 300 people. Mr. Asness has authored numerous articles on financial topics and has received prestigious awards, such as the Graham and Dodd Award for the year's best paper from the Financial Analyst Journal. Additionally, the CFA Institute has awarded Cliff the James R. Verton Award, which is periodically given to individuals who've produced a body of research notable for its relevance and enduring value to investment professionals. He's also on the editorial board of the Journal of Portfolio Management, the governing board of the Quant Institute of Mathematical Finance at NYU, and the board of directors of the Q Group. Please join me in welcoming Mr. Cliff Asness.
Right before this, I showed the dean the picture I took that I sent my wife, bragging that I'm worth 15 PDP points. And you asked me what she sent back. I had 10 minutes here before we started. She sent back, I would give you 12. We've been married like 15 years. Also, when it comes to Q&A, I hope we don't have this. I'll start with one story. This is about a decade ago. I was presenting, it was one of the largest groups I've ever spoken to. It was in Tokyo. It was something about 2,000 Japanese brokers. And I will tell you, when you come from Connecticut and New York to the Midwest, you get fewer questions on average, because I don't know how to put this nicely. You people are polite. You don't always want to ask hard questions. In New York, they're like, that just sounds wrong. You don't even come close to Tokyo. They don't ask any questions. So I finish about a 45-minute talk, which is not supposed to have questions. And just by force of habit, and it's out-of-body experience. As I'm saying it, I'm going, oh my God, I can't believe I'm saying this. I said, are there any questions? And all I can say is, you cannot describe to someone the feeling of standing in front of 2,000 people, all not asking a question at once. You have to experience that for yourself. You cannot. The title of my talk today, I don't know if you define 45 minutes or so as brief, but that part might or might not be true. It is certainly biased. I am a quantitative investor. I'm a Wall Street quant geek. I'm going to talk to you a fair amount about what people like me do, what that word means. There are alternative definitions, what it means in general, what it means to me, and my bias is that I start out believing in it. I do a lot of my presentations this way. I try to reveal all my hidden agendas beforehand. So what is a quant? This is kind of an outline of what I'm going to talk about. What do they have in common? So what does it mean? What are some true things? Is conceptions actually a word? Is there any? This is a wrong. Give me the English lit group. I'm going to talk about true things and things that we think are misnomers about quants. And then I'm going to specifically talk about the most well-known, popular kind of quantitative investing. It's quantitative equity means choosing individual stocks, using a model-based approach, using quantitative models. As you'll see, there are plenty of other quants running around what I'll very generically refer to as Wall Street. I'm going to focus most on the way the word's used the most. I'm going to talk about its past, how it's done over the long term, some rather giant events in the history of quantitative investing. Not giant events for the world, just giant events for people like me. What I think about the present. And finally, what's going on in the world of quantitative investing. I'll give you a short preview of the future. I think we're doing a lot of the same things we used to do. We're just coming up with new names for it. And I'll be more specific. You always have to try to, I'll try to have a brief, a couple of hundred of my closest friends here. I'll try to be more honest than normal. I'm usually trying to sell you something. I'll tell you the marketing secrets as we go. If something's become unpopular, has a stigma to it on Wall Street, this is not about quants. You don't have that many things you can do. You just need to come up with a different name. So I don't know what I'm supposed to say on this page. That's what people think of quants. We have some giant, scary, futuristic factory. This is the only place I've ever not had to read the caption to someone. This is like the biggest screen I've ever seen. I didn't write this. One of the smart aleck analysts who does this wrote this, but I allowed it to go on. Note this has been some confusion. This is not Clifton High School. Those records are sealed. We needed a picture of a stereotypical picture of a total geek. We ended up feeling very, very bad. Apparently not bad enough not to use the picture, but just bad enough to feel bad. Because we were using this for like a year till we discovered this poor person is the picture everybody uses when they need a picture of a stereotypical geek. We ended up finding it in like at least 4 or 5 other places. So I feel bad about it, but it is what it is. What are some other misconceptions? I'm going to try to talk you, if you have these. Some of you guys are younger. I'll talk about things like the tech bubble, and they will be approximately the same as the Teapot Dome scandal. Neither of those work? No? Okay. So maybe you don't have these misconceptions, but some common misconceptions I like to fight is the idea that quantitative investing is a black box. You have a model, and it just spits out an answer. I actually argue that it's quite the opposite. I am always at a loss for what to call non-quantitative investors. These are investors who do what you always hear about investors doing: visit companies, pick specific companies, meet with management. I have no good label for them. Some people call them judgmental managers. That makes them sound like quite harsh people. It also makes it sound like we exercise absolutely no judgment. Some people call them active managers. We run portfolios. Active usually refers to not owning the benchmark, trying to beat a benchmark. We run very active portfolios. On the other hand, calling them qualitative managers seems kind of mean. I don't think they don't use numbers. They just use them differently. But I will say that I think it's often misguided to call a quantitative manager a black box. A black box is something that you have no idea why it spits out its answer. To me, a good quantitative model might be complex, but if a client, an investor, or anyone else wants to know why you own this stock and why you're short this stock, there is a precise answer. They can be a black box if you refuse to tell your clients the answer. But if you're willing to share, and I find most quants are, shockingly, we all think we've discovered the greatest thing since sliced bread, but we all enjoy bragging about it. I have a partner who does marketing for us, and he is far less willing to share the details of the models than I am, which seems completely backwards. But he's been teasing me for 15 years now that the way to get the details out of me, if you want, many people, believe it or not, do not want to know the details of our quantitative models. But if you want to know, just tell me you don't think they're very good. And I'll go, oh yeah? I'll get a blackboard or a whiteboard out and be half an hour. Another one is that quants are trading weird patterns and they disregard fundamentals. There are quants who do that, but the bulk of quants are looking at a lot of the same things that those other kind of investors. I'll just call them non-quantitative investors, even though they might be very quantitative people. We're looking at how cheap a company is, what the growth has been, what the momentum in their both price, earnings, and anything else might be, how much risk the company has demonstrated historically. There are differences, and I'll get to that, between quantitative managers and this more typical, more well-known group. But it's not about not using fundamentals. Model-driven trading is driving with only the rear-view mirror. I hate that one. That refers to the fact that a lot of quants run backtests. And backtest is, let me come up with a rule, and let's see if I had followed this rule for the last 100 years, how it would have done. This can actually be a fair criticism in some cases. If all you've done is search for what has worked well in the past and don't have a story and don't have evidence from other places and don't have any reason why you believed in it to begin with, I think this would be a very fair critique. Just because something has worked well in the past is not a reason it will work going forward. I think most quants, and I'll say this, I think there are good quantitative investors and good, I'm going to actually say normal investors, making us the abnormal investors, are really, most of them have an investment thesis. They have things they believe lead to good returns. And if anything, the rearview mirror is simply to examine how it's done and in what periods it's done particularly well or poorly. So I think almost any kind of investor can look in the rearview mirror too much. It's a danger, but it's not a fair generalization. Another misconception, quants are highly levered blow-up candidates. This one's finally fading. This kind of goes together. The book at the bottom right, I'm kind of hoping the answer is no, but has anyone read this book? Damn. I still have not. I've read excerpts. I'm one of the protagonists. There are a whole bunch of people. There are kind of four of us who he follows the most. I'm going to tell you the whole story about this book. That's what I'm going to do for the rest of this whole talk, because this book pissed me off. In August of 2007, something I'm going to discuss was a wild ride to be a quantitative investor. There was about a 2-week period where anyone doing anything vaguely similar suffered very greatly, and then it all went away and fixed itself. And this guy set out to write a book on this. And then 2008 happened, which was not very particular to quantitative investors. That was about the world crisis. And he ended up writing a book with the subtitle, Men Who Almost Brought Down the Financial Market. Some of the chapters were on people like me. Some of the chapters were on like the guys at S&P who gave AAAs to subprime mortgages. There's an argument, and I'm sure some of those guys would be upset about this characterization, but there's an argument that those guys were related to the financial crisis. The subtitle, and then the opening chapter is about me. Don't like that. The other thing I don't like is he told a little biography of everyone, and he said I was a fat kid in high school. I am a fat guy now. I was not a fat kid in high school. How does one combat that? Do you take out an ad to combat that? I've probably ruined this entire presentation with that level of shallowness. How many of you would enjoy that? One thing, getting more serious, and it's related to both of those two. A central thesis of this book was even that during this rough quantitative period in August, that we were threatening world financial market stability. And I kind of begged and pleaded with the guy for a while. This period I will discuss because it was harrowing, but it was wildly interesting. Financial markets were up over the period. They ignored us. Quants are not important in the world. We're important to us and to our investors, but I think we got exaggerated in importance in order to I've probably sold more of this damn book by doing this whole conversation. Many of you have probably heard about high-frequency trading. That is not, I'm going to give you kind of two-edged comments on that. I'm actually a defender of it. I think it's net made the world a cheaper place to trade for anyone who wants to trade. It is not something we do. It's become almost synonymous in the financial press with quantitative trading. And let me get the logic right. All high-frequency traders are quantitative traders. They trade like every nanosecond. You really have to be a quantitative trader, or else you are the fastest talker and the most annoying person on earth. You're calling up every nanosecond is difficult. All quants are not high-frequency traders. A lot of what we trade, for instance, probably the bulk of what we trade are based on two simple concepts. And I'm going to refer back to these as I go. And they're two of the things that come out of academic finance. Value-based trading, trying to buy cheap things and sell expensive things. And momentum. The fact that even though value tends to win over the long term, what happened last Thursday tends to keep happening for a little while longer. Except the momentum we look at is even about 6 to 12 months. So we are nowhere near high frequency. When we own a stock, all else equal, we probably own it a year from now. Now, God, I sound very defensive here. You know what's funny? I haven't done this presentation in a while. People are starting to like quants again. I got to ease off the defensiveness and alter this presentation to tell you how wonderful we are. Not all the terrible things people have said. But post-2007 and 2008, which again I think was a mislabeling, people, of course, focus on the negative. Here's something I've believed for a long time. Oddly, whenever a quantitative investor loses a significant amount of money or there's a bad period, somehow there's a general indictment, and even in papers like the Wall Street Journal or whatnot, it's quantitative investing has failed. Whenever someone blows themselves up the old-fashioned way without a model, you do not see articles, well, human judgment has failed again. So I do think somehow the world is biased. There have been net good returns to quantitative investing. I told a group at lunch today something I only recently realized, that when I wrote my dissertation, I used data from from 1926 through 1990. Our presentation books at AQR, almost invariably, our academic papers still use longer data, but our presentation books use data from 1990 to the present. So what I wrote my entire dissertation on, which is still a big part of what we do, is not considered relevant data by the young people who run our models today. It's entirely new. So I've lived through 23 years of this stuff working on net. But there have been epically wild times in financial markets. You don't need me to tell you that. But I think they've been rather evenly distributed, and I won't waste your time reading all of them. But there have been, and yeah, I did sneak in qualitative. I don't even know what a qualitative manager means. We like their logo. We met with them. They were funny. But there have been disasters. Investing is about surviving disasters and having a good process. Both of these have been still good since 1990. But there have been disasters, but they've been nice and evenly distributed. But I do have a little bit of an obvious sore spot for the fact that whenever someone quantitative does something bad, I think it kind of sticks to all of us. It doesn't happen the other way. So what is quant? I keep using this. These are the three things I think make up being a quantitative manager. And I have chosen to phrase each of the three shockingly as a positive. I am hopeful in the Q&A. I don't mind being challenged at all. And I'll give you a little bit of the opposite arguments as we go, but you can push me on them. Objective and discipline. I mentioned one of the classic quantitative strategies. We've been working on trying to make ours better for 20-some-odd years, but it's still about trying to buy cheap things and sell expensive things on some things you'd recognize. All else equal, if a company has a low price-to-earnings ratio, we like it a little better. It's about that complicated. It's just a whole bunch of stuff like that. If you find yourself trying to buy, actually looking at a value portfolio, put together a portfolio that's long the 200 cheapest stocks in the market and short the 200 most expensive on simple measures. Long the stocks with the lowest average of the price to earnings, price to book, price to sales, and short the most expensive ones. When you look at the portfolio you own, you're going to throw up a little bit. You're going to go, I own this stuff? I can't believe it. These are the worst stocks. Because markets might not be perfect. And I went to the University of Chicago to get my degree, so that's a hard admission from me. They might not be perfect, but they're not complete idiots either. Markets work long term. Value investing has worked not because cheap companies are generally much better companies than expensive. It has worked because they get a little too cheap. Buying a bad company can be a good idea if the price is too low. Selling or shorting a great company can be a wonderful idea if the price is too high. So objective and discipline, we do find great non-quantitative managers can hold themselves to this. I don't think this is only quants. They can hold this discipline in their head and not get caught up. A lot of investors get caught up in the hype, and we think this is part of why things like value investing work. They end up paying too much for things that have had good times over the last 4 or 5 years, and the opposite. Another thing that's very difficult is, if you remember, I mentioned 2 styles, and there are many different things. I'm going to try to keep it simple and pretend quantitative investing really comes down to mostly value and momentum trading. That means trying to find cheap things that have actually started to get better. We find that works decently better than just buying cheap things. But they often want you to do the opposite. Something that's been doing well, has good momentum for the last 6 to 12 months, is often on the expensive side. We find, as have a host of other people, unfortunately it's not just us who know about this, that doing both, which means you end up looking for a combination of the two. And it often means compromise. It means you can't buy the cheapest stock in the universe because it's also in the process of still cratering. You can buy the 14th cheapest stock in the universe because it used to be the cheapest, but it's actually been recovering. Maybe it has both value and momentum. One additional part of being a quant and being objective and disciplined is it's very, very hard for an individual to keep both those concepts in their heads. I find I've had talks with psychology friends saying you should throw out all your personality tests. Just figure out if someone is a value or a momentum investor. It'll tell you everything. Value investors are cynical. They're curmudgeonly. They act older than they are. They believe nothing you say. Momentum investors, you're much happier people. Doesn't necessarily work better. But go, yeah, it's up. That's great. Let's have more of it. Turns out both work, and they work better in combination. But it's pretty hard to find a person who can hold both these ideas in their heads. Models help. Risk managed. I think that word is the single most important part of being a quantitative manager. An individual stock can have every good characteristic. I told you it's a lot of ways to measure value and momentum. There's a lot more to what we do than value and momentum. Imagine you have 20 things that you love in a stock. That's your model. You can find a stock that's great on all 20, and it can go down 100% tomorrow because it turned out to be a fraud. Right? You would not use the worst thing on, I was going to say the worst thing on earth. That's probably a bit of an exaggeration. One of the stupider things you could do in investing would be to use a quantitative model to bet the ranch on one stock. What a quantitative model does is want to go long 400 stocks that in aggregate have the characteristics it likes, and underweight or short 400 stocks that are the opposite. You're not betting on an individual company. You don't know much about an individual company. On that side, and here's where I said I'd be honest with you, the team visiting the company, the team who's only going to own 11 stocks, knows a ton more about those 11 stocks. That's their advantage. Their disadvantage is if they're horribly wrong about any one of them, they're kind of doomed. We are playing more of a statistical game. We are about these 400 companies of a similar type with similar characteristics on average beating the opposite. I make an analogy, and this is a dangerous one. This is a pure mathematical analogy. This is not meant to be a moral or ethical analogy. But being a quant manager is a lot more like running a casino than anything else. When you run a casino, you don't want one blackjack table with someone showing up, a billionaire showing up, and saying, I want to play $10 million a hand. Because yes, you have an edge. But if he plays right, you have a 51% edge, and you can go bankrupt pretty easily. You don't want that. And again, please stick with me. This is not a moral or ethical analogy. But what you want is 14 greyhounds full of grandmas with laundry sacks of quarters. Because any individual grandma might win, but as a group, the grandmas don't win. You have a 55% chance of taking any one of their money and approximately 100% chance of taking the group's money. Again, not an ethical or moral analogy, but quants are more like that. We want a portfolio of stocks with characteristics that on average we think lead to better returns, but we do not want to bet too much on any one thing, because statistics can always lie. They can desperately lie about small isolated bets. Finally, quants can do a few things that are much harder to do with visit the company, concentrated type managers. We make explicit trade-offs with trading costs. It's very hard to know for visit the company type people. We trade electronically. That's been a revolution. I mentioned before we're not high frequency traders, but we are quants. We're also electronic traders. That stands in the middle. That's a much longer talk. But we're two of the three. We're quant and electronic, but not high frequency. A lot of things. I'm talking mostly about quantitative stock picking, using quantitative models to choose individual stocks. You can use this to beat a benchmark like a traditional manager. If someone tells you to beat the S&P 500, you own 200 stocks that are the 200 best on your model instead of all 500. You're fully invested. You're doing nothing odd or scary. Or you can use this as a quantitative hedge fund manager. To go long your 200 favorite stocks and short your 200 favorite stocks, maybe all over the world. Make it 1,000 long and short. The hedge fund manager has to use what I call the dirty words of finance: leverage, derivatives, and shorting. To produce a return long and short, the goal is to produce a return that's unrelated to the direction of the market. Again, if that's interesting, please ask me more in questions. But there are different ways you can use a model, but they all fall under quant equity. You might hear a lot of this. High-frequency trading, which I am walking the line of both, again, vigorously denying I'm a high-frequency trader while telling you I think they're still nice people doing a good thing. Something called statistical arbitrage. Quant macro, there are people who trade. There are George Soroses who use models. I don't know if he would like that characterization, actually.
Systematic trading?
Yeah, I'm going to distinguish that. Managed futures are systematic traders who almost invariably are trend followers. Their main way, and it's a great question, the main way they trade is buying what's been going up in the last year and selling what's been going down. Turns out, if you are a fan of efficient markets, and I've strayed, 20-some-odd years ago, I was more in that camp, and I think living through the tech bubble and the real estate credit bubble, among other things, have probably certainly weakened me on that and made me more of what's called a behavioralist, an idea that markets can be very good long-term but aren't perfect and make some errors. Managed futures traders largely buy what's going up in the last 1 to 12 months and sell what's going down. They don't even do the value part usually. It's been an annoyingly good strategy for 100 years. We wrote a paper recently on this called "A Century Plus Evidence on Managed Futures." There aren't many things you can test that long, but because they only trade indices, they don't trade individual stocks, our data goes way further back. Quant macro also often includes things like value and carry trading. It's trend following, but they're also looking for what parts of the world look cheap, what parts of the world offer positive carry. Positive carry is, I call it the lazy person strategy. It's if prices don't change in the world, things still have different returns. For instance, it's very good to have a higher yield if nothing changes. Sometimes those blow up. Those are interesting strategies. But the point of this slide is, actually my firm gets involved with about 4 or 5 of these, not all of these. But other people might define quant differently, and if you hear the term differently, they're not necessarily wrong, nor am I. Quant equity is by far what most people mean on Wall Street. If they mention, oh, that guy's trading is a quant trader, they usually mean trading individual stocks in the way I'm going to describe, and that's what I'm going to focus on. So there's been a progression of research over the years, and we've certainly been part of this, but a small part. A lot of it for me, and I'm very, admit I'm at a different university, but I'll say I'm University of Chicago biased. It's where I studied. Gene Fama and Ken French, to me, started a lot of this. So other people might dispute that. They're not in the room, so I'm safe. They were in the mid-'80s, and I showed up at Chicago in the mid to late '80s. They were doing research into value investing. Their research was pretty unique. It was not unique in that it liked cheap stocks. People have been talking about that forever. Certainly guys named Graham and Dodd, for instance, which is business school students, some of you are, you've probably heard of them, would get a little annoyed. Were they alive? That is a prerequisite for being annoyed. But if I said Fromm and French invented value investing. But what they did was test, they didn't call it this at the time, but a quantitative approach. Graham and Dodd were much more about stock picking using value criteria. Fromm and French were much more about this idea of, does a systematic cheap portfolio, diversified, not beholden to any one stock, systematically beat an expensive portfolio? I wrote my dissertation for them on adding momentum to that. That's one of the few things I was actually pretty early in, investigating how price momentum worked. And this was a scary dissertation to write at the University of Chicago. You might have quite open-minded professors at the University of Missouri, but at Chicago, we were efficient market people. And I had to go into a guy named Eugene Fama's office. He's the godfather, demigod, I don't know what you want to call him, of efficient market theory. And tell him that I want to write a dissertation on price momentum. Buying what has been going up, selling what has been going down. When I want to be sarcastic, I call this the two-newspaper strategy. Meaning you need a newspaper from a year ago and a newspaper from today. You don't need big database. You need to be fast. Computer would be better. And here's the hard part. I need to tell them it works. Because a perfect Gene Fama efficient markets University of Chicago dissertation is, I study this price momentum strategy that some people on Wall Street use. Turns out it's idiotic. And those fools are, again, losing their money trying to beat the market. And I told this story at his 65th birthday. He remembered it too. I said something like, Professor, I'd like to write my dissertation on price momentum. And by the way, I find it works extremely well. So what was that? It works. Part of the reason I graduated was I did not say do this instead of value. That would be both bad portfolio management and career suicide. I pointed out that both it and longer-term, slower trading value seem to work and actually seem to complement each other very well. Over the long term, both seem to add return, but when one is having a bad period, the other often has a good period. We had to figure out, is this stuff for real? Remember I mentioned that it can be a real critique to look through the rearview mirror. That's not necessarily a false critique. That can be a real one. Look, a term in the industry is data mining. In some industries, this is a positive term. If you have enough good data, maybe it should be a positive term. But in economics, it's almost invariably and correctly used as an insult. If you say, oh, that paper's data mining, what you mean is you had no theory, you had no idea how it would come out, you tested a million things, and you reported the one that seemed to work. So if everything has a 1 out of 1,000 chance of working, randomly, for 50 years even, and you test 10,000 things, even if nothing in the world works, you're going to find 10 that work. Kind of sums it up. So how do you make sure that you're not finding something random? Well, first of all, you never make sure. We're statisticians. We never, ever say we're sure. We say the chance we're wrong has gotten smaller. It's an inherently wimpy profession. In real life, you say this works. Statisticians go, there's only a 1% chance we're wrong now. That's actually intellectually honest. It just sounds so damn wimpy, it still bothers me. The thing you dream about as a statistician, financial or otherwise, regular people dream about houses and cars and significant others. Statisticians dream out of sample tests. We believe if we get good out of sample tests, that will lead to nice cars, nice houses, and nice significant others. But the primary thing is an out of sample test. And why is that so important? You found this thing that works. You didn't data mine, you had a theory, you didn't test a million things, you didn't cheat. Still could be dumb luck. Fromm and French could have been dumb luck. They tested stocks originally from 1963 to 1988 in their first paper. We've since been able to test back to 1926 and had the 35 plus years since their paper. Out of 25 plus years. Yes, I have Quant in my title. Did I mention that? I can't do math in front of people. That's called an out-of-sample test. 25 years of we found it, is it going to work in the next 25 years is wonderful. Another kind of out-of-sample test is does it work in another place? I was lucky enough, and there's a lot of dumb luck in anyone's career, and I will readily admit that, at Goldman in the early 90s to be asked to try to implement these models on real money. Why someone would let me do that at that point is a question that I thank God they did. No idea why someone would let me do that. I wouldn't let me do that looking back. But we had to prove to ourselves, does this really work? A different kind of one out-of-sample test is to wait 25 years. That's a really bad career move. To go back to the then partners at Goldman and say, all right, here's what we're going to do. We're going to wait 25 years. If this stuff holds up, we're going to pounce. Bad move. We ended up going around the world, testing what we do for individual stock selection in every country we could find. Even though I'm going to focus on stocks, looking at it for currencies, to pick bond markets, to do other decisions, and found that the general ideas of value and momentum held up very well. So that was very good news for us, a different kind of out-of-sample test. I have no idea what to say on this page. We've done a lot of research over time, and someone would like you to know that this is actually not all the research we've done. There is a conflict in the quant world. I know this is very important to you. You follow it in the newspaper every day. It's a burning issue. Everything going on in the world, Syria, horrible problems, and you're very upset about the quant debates. But whether to add, the best thing is to stick with old models or try to make models better. That is a very hard thing to try to figure out. Nothing we do, I use the word works a number of times. You heard me. I should have said it at the time. I use the word works like a cowardly statistician again. If something works 2 out of 3 years, most but not all 5-year periods, for 100 years, I proudly say it works. But everything a quant does, everything any investor does, frankly, Warren Buffett has had disastrous 5-year stretches, is subject to not working at a time. I happen to think new research is great. My firm has pushed the boundary quite a few times. Remember that? That's why that page was first. We were supposed to impress you with the research. But I am one of the heretics in the quant world who thinks it's at least as important to stick with some of the same things we've been doing for 25 years. Because I think they still will work going forward. Human nature has not fundamentally changed. Adding new things is great if you believe in them. But the hurdle that you will find new things as good as your prior things again and again and again should get harder and harder. So here I've let you in on a debate and settled it in my favor. This is what happened in August of 2007. This was a typical quantitative portfolio. Down 10% is a fairly horrible year for this portfolio. It was down near 10% over approximately 4 days. This is terrifying. What actually happened, August of 2007, some of you who've looked at the financial crisis might remember, people argue about when it officially started, but a lot of people date it from July of 2007, when we first saw the rumblings of problems with credit, saw some fairly negative returns to anything liquid linked to real estate. Real estate takes a while to show up, but things like REITs and whatnot, any credit instruments. And what happened was a lot of really hedge funds had seen great long-term track records of quants, added quantitative strategies to what they do, as hedge funds are wont to do in a levered, aggressive manner, got smacked in July on things that were unrelated to quant, and said, what can we take down fast? They like to cut their risk rather fast. Turns out quants had the dubious distinction of being what in the markets is called quite liquid. You can get rid of us quite quickly, but obviously not without some impact. This was probably the scariest professional 3 days of my life. Interesting, if you go back, most databases you will encounter are still monthly. The most famous database in the quant world is the Ken French, maintains a wonderful one on his website. Gives you mostly monthly data. you won't find the most harrowing event of my entire career, because it pretty much all recovered by the end of the month. It's like having a traumatic experience and you're in a Hitchcock movie and everyone else is saying it didn't happen. Look, what this shows is there is not a strategy in investing, quantitative, less quantitative, any field, that is not subject to the risk, even if it's a good strategy, even if it's a fairly priced strategy. It's not even stretched, to a lot of people trying to get out the door on the same day. And we went through that, and that was the beginning of this book, so I wanted to tie up loose ends. That became a book about the financial crisis. Have I mentioned that? But if you go back and look at the data at the daily level, this was, again, the scariest professional 3 or 4 days of my life. It all is gone. Look at the monthly data, nothing happened. So here's, I've not been doing this, rumors aside, since 1956, but this is the world's simplest quantitative strategy. If any of you want to, you can go to Ken French's website, type in Ken French data, it's the first hit. You can download his version of a value and a momentum strategy, and put I do 2/3 value, 1/3 momentum, because it's kind of what we do. And this is a rolling 3-year performance. First of all, notice the red line isn't 0, it's the average. So it rarely dips below 0. It did dip below 0 when that 2007 period happened, and then recovered rather quickly. It's been coming back. If you extend this, it's actually back even further. This is why I said I'm being too defensive. I'm still giving this presentation a little bit. But this is what happens. This is something I have fought against and lost. The investing world looks a lot like this. When the rolling 3 to 5 years is good, everybody loves you, and you get inflows. When the last 3 to 5 years is bad, it's a lot nastier than this. I've written the nice version of what they say. There should be punctuation marks all over this. By the way, it's not as predictable as this looks, too. If you actually try to trade this, you're better off doing almost nothing and just sticking with a strategy that's good long term. But if you're going to trade this, you probably want to be a bit of a contrarian. Do more of it when it's been bad for 3 to 5 years, and do less of it when it's been good for 3 to 5 years. The world does the opposite. This is something I've given up on. I am fond of pointing out that if the world did everything rationally, I think I'd have a lot less to do. I will tell you one story about that. Again, the different bad period. I have lots of bad periods. Apparently, have I mentioned the stuff has worked on average? That's why I'm here. I'm only sharing bad news with you. Our first year in business was 1999. Our first act was the combination of value and momentum, declaring it a bubble, particularly tech stocks, but not only tech stocks too expensive, and shorting a bunch of them. This obviously ended up working out for me. The way you figure that out is I'm in front of the room talking. It's called survivorship bias. That actually has a name. If it didn't work out for me, I wouldn't be here. But it was a disastrously painful start. It's okay to have a bad year. Not a bad 3 years, really, in this business. But it's okay to have a bad year. It's not okay to have a bad first year. That is not fun. In fact, what was this? Somewhere during that year, maybe actually the next year, I called it the worst year of my life. And my wife was present, and she said, we got married that year. And I try to remember to say, again, the worst professional year of my life. It is different. Though I spent a lot of time on the honeymoon worried about this. The other thing, the reason that made me thought of this, think of it. See, I'm not allowed to make a math mistake in front of people, but I'm allowed to mangle the grammar, because that's what you expect from quants. Remember a second ago I was saying I should actually be happy that the world makes behavioral mistakes, rushes into strategies at the time they should be rushing out, and vice versa, because that's kind of a big part of how I make my money. Well, my wife called me on it. It was sometime in late 99 or early 2000. I was complaining about how crazy and insane this tech bubble and how stupid the world was. I think I, again, probably said it a lot more graphically than that. And all she said to me was, "Thought you make your money because people make mistakes." And she left it there. She was too nice to keep pushing it. But she's basically saying, "My God, you're a whiner. you make your money over time. You believe you make your money because people aren't perfect, they make mistakes. And now you're whining to me that their mistakes are too big. What you want, which is absolutely true, is investors to make a bunch of small errors. You don't have to make big bets. And after you put the position on, meaning you think it's a cheap thing with some good momentum, investors to go, oh, Cliff's right. But when they continue to make an error even bigger, you get upset. So this has been a hypocrisy I've lived for many years, not just for you. But I get annoyed every time I talk about these things, yet it is how I make my living. I'm going to skip this one. I'm going to talk a little bit past value and momentum now. What are some of the other things that quants do that have been added? I think if you go back to 1990, it was pretty much value and momentum. The world has expanded since then, and I'm only going to share a few of the expansions. I alluded to this, but what do we look for in any strategy, with value and momentum being two of the biggies? Persistent. Has it worked over the long term? Pervasive. Has it worked in many places? If you can form a version of the strategy for picking stocks in another country, if you can look at a strategy and go, well, if people make this error for picking stocks, what would it mean for bonds? If you can then go test it, it should work the same way. Not necessarily exactly the same numbers, but if it fails, you really should step back for a second and go, well, has this blown my thesis? Dynamic. You shouldn't cheat. A lot of people in our industry cheat. You can look through a lot of strategies at the end of the day, or net long and praying the market goes up. That's okay if you're Jack Bogle and you're charging 8 basis points for it. It's not okay if you're a hedge fund charging 2 and 20. We also, this is not necessarily something everybody needs, but to run at our size, because we are actually getting to be a fairly large fund and firm, liquid and be able to be transparent, be able to explain it to your clients. I'm skipping a few now due to long-windedness. We have added 2 main categories over time to value and momentum. A lot of little things have been added also. I don't want to imply this is everything, but added 2 main things. One is carry. I mentioned this earlier. What happens if nothing happens in the world? Currency is the most famous carry strategy out there. Buy a high-yielding currency, short a low-yielding currency. That strategy has a small problem of occasionally almost ending your life. It's what we call a left tail strategy. That's a wonderful euphemism for strategy where the downs are much bigger than the ups. That sounds really bad, but the ups have been far, far more frequent. You've actually made a lot of money doing a carry strategy if you manage not to die for the last 50 years. But carry is a pervasive force we find in every market. And the weirdest one, and one I want to spend a second on, is defensive. In every market we've looked at, and again, we kind of demand these things work ubiquitously, not just for one investment decision. Financial theory has not held up as well as I would have expected it to when I was that PhD student in the 80s. In financial theory, and something I'm going to get your professors all mad at me, though they probably agree at this point too, most people have come around on this one. Financial theory says a higher risk firm, a higher risk country, a higher risk currency, a higher risk bond market should return more. Well, what we found is using various definitions of risk. You can use volatility, you can use the academic's favorite, which is a market beta for those of you who've studied it. This relationship has been almost totally flat. It's supposed to be upward sloping. I'm trying to do the mirror. Yes, that's upward sloping from you guys' perspective, too. It's a great brain teaser. Ask people how come left, right gets flipped in a mirror but not up, down. Watch people kind of freak out about that. That's my Google question of the day. I can't answer it, by the way, so don't ask me. If things are incredibly flat, now you're much more interested in that than anything I'm going to say, which is annoying. If things are incredibly flat, you can do better by overweighting low risk. Why would you accept high risk and not be compensated for it? So if we're building our perfect portfolio, again, I'm simplifying for the sake of a presentation, but our favorite stock in the world, our favorite currency in the world, our favorite bond market, would be one that on the measures that we've tested and think are intuitive and relevant is cheap, that has good momentum. We actually like it to have been working for a while, and we're willing to give up some cheapness. The existence of good momentum means you're not buying the precise bottom. If it has to start to work first, you're giving up on that. We just find it more consistent. We like to get paid if nothing happens. Didn't have to work. It ends up being a very effective strategy. Carry is a form of risk, and it's quite clear it's a form of risk. It's not a free lunch, but we think it's one that you get amply paid for bearing. And finally, if we have our perfect druthers, we'd also like that security to be lower risk than the average. That's all we want is cheap, good momentum, be paid to do nothing, and have low risk. Is that so much to ask? It's very rare to find one stock, again, I can expand it, country, currency, bond market, that has all four of these characteristics. Some of them are explicitly offsetting. Value and momentum often go the exact opposite way. Others are just unrelated, and finding one thing that's very good on all of them is rare. But you can, interestingly enough, pretend you're buying a conglomerate. Pretend your portfolio of 500 stocks is one conglomerate. You can choose those 500 stocks from 5,000 around the world. So your portfolio really is better on all four of these than either things you're short if you're a hedge fund or a benchmark if you're a traditional manager. So that is what a quant does. Decide what we care about. That's why I said in the beginning, you need an investment thesis. I do not believe, some might dispute this, I do not believe in a quant style that just says pattern match, find things that have worked in the past. I think you have to have an investment thesis. You need to be able to test that through time. You need to be able to test that in places you haven't looked at yet to make sure you're not cheating. This is essentially, in simple terms, my investment thesis. It is unfortunately, sadly, and annoyingly not unique to me. We've done much of this research. We've participated in it, but we've also piggybacked off the academic research. A guy named Fisher Black, who certainly had he not passed away would have shared the Nobel Prize, proposed doing this at an index fund he worked at, instead of buying all the stocks, buying the low beta ones. In 1972, we have a memo to it, and we include it in our presentation just for fun. They laughed at him. They were already doing index funds, which is heresy for 1972. There was a time when index funds were called un-American because they accept mediocrity. They accept the average. It's much better to pay a lot for active management and get less than the... No, don't start me. But Fisher proposed this, and we just basically noticed. 40 years later, we said, hey, has anyone actually tested how Fisher's idea worked for the last 40 years? It turns out they really should have listened to Fisher. Not every one of these things can be done everywhere. Stock picking. I lied to you a little bit. I pretended you could do both carry and value. Not one of you called me on it. What's carry for a stock? It's the dividends you get. I told you if price doesn't move, what do you make? Those dividends should be all in. You can count share repurchases. Value are things like price to earnings, price to cash, price to sales. Turns out those are almost exactly the same things. In geek speak, they're highly correlated. So you can actually do both. You just wouldn't want to. You'd be double counting. I lied to you when I mentioned currencies and defensive. I was just being broad. Lie is a strong word. If you have a low beta currency, a low volatility currency, which one do you go long and which one do you go short? Currencies are always two-way. Theory doesn't tell us anything. But most of these four things that we believe in apply in most things you can trade around the world. And we do fairly simple stuff. People think we do complex stuff. We do simple stuff with a great deal of discipline in a lot of places. Now, I think that just says, yeah, it's worked. There's no quant ever. It could be data mined or it could be true, but no quant ever doesn't have a backtest to say, hey, you really should have been doing this for the last 20 years. And this is what I was referring to. That just pisses me off, 1990 to the present. Too much? All right. I'm going to end with this. This is more pragmatic about the industry. And it is the closest thing I will come to trying to sell you an investment. Now, getting the 150 students in a room and trying to sell them an investment is really not a very good business plan, I got to tell you. So there's a flaw to what I'm about to do. But we think over time these 4 styles, let me give you a little tour. In 1990, apparently that's a very important year to me. I didn't realize till this presentation how important that year was to me. I think just doing value and momentum in that quantitative fashion in so many places at once was a form of what they call in investing alpha. Alpha is a very overused term. We called our first fund the Global Alpha Fund. Worked kind of well when we were there. Goldman Sachs closed it 8 years after I left when they were having a bad time and we weren't. I was not mentioned for 8 years of the news story, yet when they closed it, it was a fund started by me. This is a little bit of, I'm trying to end the same way I began the presentation, with some bitterness. I like to think, as successful people go, I am quite bitter. I want that ratio to be very, very good. Historically, people like me have charged you a lot for access to these. These styles, if you were doing them early, I think it was fair to charge a lot back in 1990 to do value and momentum in 10 different places around the world. No one else knew how to do it. It was new. I think the cat's out of the bag. For instance, if you guys didn't know about it, you know about it now. I like to think we've developed some expertise in doing it, but the main thing is knowing the general idea. You guys are smart people. If you spend a couple years trading it, you get good at it too. So people have to start being more honest and more transparent about what they're doing if it's simple, and changing their fee structure. So the world has largely done this in a hedge fund context or an active management context and charged a lot. Make a long story short, I won't go through it. This violates this. Like, you go to Goldman Sachs presentation school very early when you're there. This page violates all of it. Way too many words. What it basically says, I'll give you the gist, is it is absolutely fair to charge what active managers or hedge fund managers charge if you have what's called true alpha. Returns that you can't get anywhere else but at that manager. This will be the second worst thing I'll say in the presentation. Remember the grandmas? When I need to explain alpha to someone, I forgot you're taping this. This is even worse. I use the example of illegal inside information. Again, let me be clear. I am not advocating illegal inside information. I am simply saying that if you have a stock picker who possesses it, it looks a lot like alpha. You show them against an index. You say, yeah, they're related to the index, but God, they beat it by 10% a year. Great researchers who are completely honest. One way to think about it, if you want to be a negative kind of person, I don't know if this is negative, but they're trying to approximate some of the advantage of the illegal kind of inside information by great diligence and insight. They're trying to figure out something other people don't know. It's legal inside information is one way to put it. They just come at it through legal means. If you have something that good, some of the prices that hedge funds charge and active managers charge can be quite fair. We think, I should say we, it's not just me, it's a lot of research, a lot of years at my firm, that a lot of people, even some with very good track records, are actually doing things that are far simpler, that look a lot like those simple styles I was showing you before. And maybe it was fair to them in the past to charge quite high prices for it. We think it's less fair these days, and we think the market's going to change in that way. And as I said in the beginning, I talk a little bit about the future. Trust me, as a business person, people just want to pay me a higher fee. After explaining it to them, I like to think I'm honest. I would accept a higher fee. I just don't think that's where the market's going. I think over time, some of these strategies will continue to work because they work against natural human nature, and I don't think that's changed. And there's not $1 trillion in them yet. If anything, there's less money in them than before 2007. But I don't think people can charge the fees they used to if they're being honest about what they're doing. If I try to do a conclusion, and this will scare you given the presentation to this point, anytime I've tried to do a conclusion, it comes out 80% as long as the presentation itself. I basically give the presentation again. So I will skip that and hope that you have at least one more question than 2,000 Japanese brokers.
Question time?
Yeah, please. have a lot of questions.
I'll let everyone else get in. It's a very, very good speech.
Dude, actually, really quick, because we are recording it, if one of the guys with the mics.
Oh.
Yeah, Tommy, why don't you, since you're on, give that to me.
Wait, really, really good. Was that your question?
What's that?
No, go on.
I wanted to ask you about have you guys changed your models at all in the last couple of years to accommodate like fat tails or black swan events or anything like that?
A little bit is the answer. And this is art, not science. When something big happens in the world, to be honest, let me rephrase it to the group. Fat tails, black swan events, these are things wildly unexpected. If a statistician expects to see something once every 20 years or once every 1,000 years, and you see 3 in a month, that's a black swan event. And Nassim Taleb is the author of the book, The Black Swan. I think he coined the term. But fat tails, Nassim doesn't always acknowledge this, but people have been studying fat tails for about 30 years. I think more often than not, we end up doing less than you would think. I'm going to try to turn that into a positive. It might be hard from this point. I think if you've designed a process that you're happy with, financial markets, you're crazy if you think they're well-behaved to begin with. You should be designing a process that is rather robust. There can be an event that can be past the point anyone anticipated. I would argue 2008 was not in anyone's real set of expectations. But it shouldn't be so far off that it should kill you. Is that science? No, that's art. What have we done? Since 2008, this will get real geeky, but in portfolios that are supposedly market neutral, meaning long is about the same amount that they're short, we used to allow them to drift away from that more. There was some power to that. When they ended up being net long, they did better. Markets tended to rise. We seem to be picking some of that up. But it worked, that got very dangerous. It worked out positively for some, negatively for others in 2008, but it was incredibly volatile. So we're tighter on that. We're a little shorter term in estimating our risk. 2008 might never happen again, but was an example where the risk levels changed far faster than ever before. But these were micro changes. Most of what we did was, and this was rewarded, stick with what we were doing, which is often, if I can be philosophical for a second, the harder thing. And part of it is business. It is actually easier to go to people in a tough period and go, we figured out what was wrong, we fixed it, than to go, stuff happens sometimes, we still believe in it. That second one is very often closer to the truth, but is a tougher sell. And I'm actually kind of proud that sometimes I've been willing to, and our firm has been willing to say that. Not that we won't change a model, but a big event doesn't necessarily have us run to the drawing board. We've seen a lot of big events in our life of doing this, and surviving is important. But yeah, that's important. That's a great business lesson. Survival is important. Someone write that down.
Do we have one last question over here at all? I thought I saw a couple of hands go up at the beginning. No? Okay, one. Okay, up here. Go ahead. Go ahead, Sam. Thank you.
So I'm sure you might not want to talk about this since you said before that the subject of high-frequency trading with you might be a little bit sensitive since you do support it.
No, it's just I try to walk a line that's honest but sounds wimpy.
My question is while I do agree to a certain degree that high-frequency trading has made markets more efficient, has brought greater price discovery, there's been a lot of arguments, and I would say this is probably particularly more on your short-term traders and more on your very short-term speculators, that the information asymmetry that's happened because high-frequency traders, particularly some of the large firms, have been able to place their servers and their information, or their sources of information right next to the servers for most exchanges.
Sure.
Do you think there's any potential negative consequences for your average investor, or just your typical fund at that point, just from the ability for high-frequency traders to get that information and decipher that much more quickly because of that closeness of those servers, how that could affect them?
Let me break this up. I know we're running out of time, and I will answer in parts A through F. Okay. No, it might come out that way. There are various versions of this. there is a version I don't like at all, and I've just written something on high-frequency trading where I largely defend it, but I say it's not a blanket defense. There have been cases where they're allowed to peek ahead at order flow or whatnot. At the very least, exchanges should have to disclose that. I don't know, I'm not a big regulation guy. It kind of chokes in my throat when I want to prohibit things, but I get close on that one. At the very least, they should have to disclose that because they are absolutely getting information. Putting your computers next to the exchanges is a great question. The industry term for that is called co-location. Like so many scary or not scary, whatever things, the name sounds so innocuous. One thing I like about this, which is nothing, only dimly related to what you asked, it is the only part of investing where I can tell you the speed of light actually matters. Where, you know that little C physicists use? There are geeks, we don't do this, but there are geeks like me with that in their models. That freaks me out. The idea that one day I could be using the speed of light in my models. Because you put it next to the exchange, because if you're further from the exchange, your order, which is electromagnetic, which is light, takes longer to get to the exchange. That's how quickly it matters. My belief is high-frequency traders do very, very little trading on, oh, this information came out, we're going to get in front of it. For one thing, they almost always are balanced. They leave for the day flat. Some people say they cause bubbles. I have no idea how someone who leaves flat every day, meaning they have no position, can cause a bubble. But in principle, what you said could be a minor effect. I kind of believe in a free market, and they have to pay to co-locate. They get a small advantage, very small advantage on true information, and they got to pay a bunch of money. Though I do think the reason that they trade so quickly and update, this gets billed as nefarious. They do what are called cancel and corrects all the time. So they say, we will buy IBM at 40 and we'll sell it at 41. It's way wider than a typical bid-ask spread. But, as soon as the market moves a tiny amount, they cancel those two and they move it. And that's most of what it sounds really boring. This is most of what high-frequency trading is. That's called market making. They actually have no opinion on IBM, but they want Bill, my colleague, to buy it at 41 and me to sell it at 40. And if too many people are buying it, just like a bookie, again, this is an analogy that's mathematical only, they'll change the odds and they'll skew what they do. That's where I think maybe we both agree. They basically, it used to be a cartel market making, and it's not a cartel anymore. And a lot of the resentment, I think, towards high frequency comes from people who used to make this money that high frequency managers now make. Yeah, but we've seen this. Look, if someone automates me out of, I'm not going to pretend I'll like that, but this has gone on throughout history. People who have been automated out of a job are rarely happy about it. And high frequency trading sounds very, very, very scary. I think what you're saying certainly can go on. I think there are worse practices you didn't mention that I actually would come close to banning and at the very least require disclosure of. But I think most of what they do is very mundane. And they actually make a fair amount less money than people think. When you look at the total that's taken out of the market by high-frequency trading, it's big numbers, but it's not big numbers on market scales. So, yeah, we're still trying to figure out how to regulate them. By the way, most of the issues, the glitches, that's such a mild word for some of these terrifying events, have been much more about electronic trading than high-frequency trading. And that genie is not going back in the bottle. We are not going to suddenly stop what is most of the trading that goes on nowadays, which is electronic, and go back to open outcry by 4 guys under an apple tree on Wall Street. It's just not going to happen.
Yeah, it's the floor trader at that point, the open outcry is pretty much about in the street has been for the last 10 years or so.
Great. Well, thank you guys. I enjoyed this a lot. It was fun.
Before everyone leaves, I'd like to just thank a couple of folks. First, academic support for the video for today. LG Patterson as well for the photos. The Dean's staff for putting together this event, and of course the Vaughn family for making this event possible today as well. So before we adjourn, I'd like to present Mr. Asness with a plaque. So congratulations or thank you so much for being here today and for being a part of the Bond
That's awesome.
Series. So really appreciate it. Thank you.
Thank you.
All right. At this time, I'd like to adjourn. Thank you.